Hi guys, this is Rob Wilson from Instant Trading Results. In this video, I'm going to be teaching you the incredible strategy of writing naked puts. First off, I need to read you this disclaimer. Unique experiences and past performance of anything discussed or demonstrated today is not guaranteed and may not indicate future results. Examples are non-representative of all trades. Certain trades may have substantially worse performance than indicated. All markets have inherent risk, and there is always the potential for loss. Today's lessons are for educational purposes only. Now, I do not have a financial services license, nor am I licensed to give personal financial advice. So again, today's lessons are for educational purposes only. Okay, now we've got the formalities completed. Let's get the learning underway. My objective is to give you a better understanding on how to trade options. This will enable you to stack the odds in your favor to become a more consistently profitable trader. When you learn how to trade options, you will never buy another stock again. And when you learn how to be an options seller, or also known as an options writer, you will never buy another option again. So my main goal during this video is to teach you how to be an options seller. Now, I'm assuming that you've already watched my Options Essential video. If you haven't, please go and watch that first, because you need to understand a lot of the basics of options first before you progress to this video. So what are options? Well, there's a call option and a put option, as I taught you in the previous video. There are two sides to every trade, and there are some things here that I'm going to duplicate from the first video just to lock it in to get you to understand what we're doing here. So there are two sides to every trade. Every options trade, whether it's a call or a put, has to have both a buyer of that call or put and a seller, or the writer, of that call or put. So as you can see in the diagram there, we've got the buyer. They pay a premium. They pay the premium to the seller or the writer. And the seller or the writer then assigns rights to the buyer. That's why they're paying the premium. So buying versus writing. There are two big reasons why we write options instead of buying them. Number one, probability of market direction is 66%. I'll go into that in a lot of detail in the previous video, my Options Essentials video. If you haven't watched it yet, I'm going to tell you again and again, go through that video to learn the nuances here. Two, over 80% of options expire worthless. So I'm going to ask you again, because I've asked this previously, why on earth would you ever buy something that has an over 80% chance of expiring worthless? It just doesn't make economic sense, does it? So with these odds, doesn't it really make sense to be an option seller instead of an option buyer? Now, buying options is directional trading. It is the most difficult form of trading, as you have to predict the direction of the stock. Now imagine learning how to trade and it doesn't matter if the stock goes up, if it goes down, or it goes sideways, and you still make money. Would you like to learn how to do that? Well, you're in for a really nice surprise today. Calls, puts, and their outlooks. Selling a put is long, it's bullish. You think the stock is going to be worth more later, so you want to lock in today's price to buy later at a profit. For example, let's say a stock is trading at $20 and you think it is going to go up. You would sell a $20 put for $1 to lock in the price to buy it later at a profit. Selling options is money in, and that's what we like, isn't it, guys? We like to bring money in. Bring it into our account. Don't spend money, bring money in. If the stock goes up to $25, you have the right to buy it for $20, therefore making $4 per share, $5 minus $1. Writing puts is a bullish strategy, and that's what today's lesson is all about. The writer has the obligation to buy the stock at the strike price on or before the expiration date. Limited profit potential if the stock goes up or stays flat. See, the most that you can make when you write options is the premium that you bring in. Losses are limited to zero if stock goes down. Now, where I'm saying it's limited to zero, it's meaning it's limited that the stock can go down to zero. The losses keep growing and growing and growing, right, as it goes down in value. Chances of this trade being profitable, 66%. Now we want to stack as many odds to our favour. So when we're building our strategies, we want to look at odds like that. What are the chances of the trade being profitable? 66% is pretty good odds, isn't it? Now why do people trade options? Well, they want to hedge their stock portfolios is a reason. Put options can be purchased to hedge stock portfolios. They protect the downside risk of owning stocks. They increase in value when the underlying stock decreases. Let's take hedge funds as an example. They buy millions or billions of dollars worth of stock, and the managers are pretty prudent. They'll go and buy put options to protect those stocks. So if they manage that right and have the right ratio in there, right, they can really mitigate their risks. Because if the stock goes down in value, the put goes up in value. It's a kind of insurance. So writing puts, when you write or you sell puts, you are selling someone the rights to put their stock to you. You are effectively selling them insurance. Stock traders buy puts to protect their stocks. If their stock goes down in value, they can minimize their risk. They minimize the risk because the puts go up in value when stocks go down. And what about the option gamblers? They buy puts because they think the stock is going to go down in value. So there are two kinds of people that go and buy puts. Now remember, over 80% of options expire worthless. So we want to sell puts to the stock traders who want insurance, and we want to sell puts to the option gamblers who are trying to pick the direction of the stock. So there's a great market for this. There's lots of people that want to buy these puts from us. Now the novice options traders buy cheap, out-of-the-money options. You'll learn more about that in my Options Essentials video, the video that you should be watching before you watch this. So let me say that again. Novice option traders buy cheap, out-of-the-money options. Take their money, take the premium, and play the odds. If they want to do that, take it. They're sitting ducks. If you don't go and take that premium, someone else is going to take it. They're going to be waving all this money in front of you saying, please, please come and take my money. Take it. 80% of options expire worthless. We want to be the insurance company selling the insurance or the put so we can collect the premium. And we also want to be the casino, the house, selling the bet, which is the put, so we can collect the premium. Now let's think about those two scenarios, guys. Insurance companies and casinos. They stack the odds. They always stack the odds. They have to. That is their business model. They stack the odds. The insurance company is going to charge a higher premium if it's a higher risk. And the casino is going to have better odds when people bet. So we are the insurance company. We are the casino. Writing puts, some important entry guidelines. We sell or write a put at a price that we don't think the stock will go down to. So we check our support levels. We don't want someone to put the stock to us. We just want their premium. We don't want their stock. So we always have to check our support levels first. Point number 2. The strike is below support. See, that support level is our protection. 3, we want high implied volatility, IV, so we can capitalize on decreasing IV over time. I'll talk about that more in our advanced training about IV, but just think of that for now. We want high implied volatility. The expiration date, we want between 30 and 60 days. Don't do short term. Don't do, oh, it's going to expire in a week, because then we're really relying on the direction of the stock. Look at 30 to 60 days in time, because that's what we're doing. We are selling time. Point 5, we want 75 cents or more in premium. That will give us $75 or more per contract. And point 6, we want minus 20 or less delta. And that will give us an 80% POP, or probability of profit. We'll get into that in a lot more detail with our trading. So let's have a look at delta now. Delta is one of the option Greeks. It's the amount by which the option price will change if the stock moves up $1. For example, if a put option has a delta of minus 80 and the stock moves down $1, your option premium should increase by 80 cents. See how the delta on a put option is a negative number. The delta on a call option is a positive number. Now, delta is a great indicator of POP, probability of profit. For example, if a put option has a delta of minus 80, then it has an approximate POP of 80% to expire in the money. And we don't want it to expire in the money. When we're selling options, we want them to be out of the money. So that's why on the previous screen I said on our entry rules we want a delta of minus 20 or better. Put options have a negative delta. A minus 20 delta means that the stock has an approximate 20% chance of being in the money at expiration. That's what we want. We want our sold option to be out of the money at expiration, so we can use delta as a means of determining which option to sell or write. It helps us stack the odds 80% or more in our favour. That's great odds, isn't it? 80% or more chance of winning on this trade. There are more Greeks. There is also gamma. That's the amount by which delta will change if the stock moves up 1 point or $1. There's theta. That is the amount which an option's price will change if 1 day passes. That's something pretty cool to look at too, is theta. Okay, so if the stock stays flat, the option is still going to decrease in value because of time. And theta gives us an approximate value of that. Vega, that is the amount by which an option's price will change if the implied volatility increases by 1%. So there's a real science to options. There are so many different things that we can analyze with options. We can look at so many different things to stack more odds in our favour. However, simplicity rules. We can make our trading as complicated or as simple as we want. I'm not really educated, okay? I only did year 10 in high school. But I have a diploma in making money. And I make my money by keeping it simple. And that's what I suggest that you do as well. Paper trade and practice my simple rules. When you learn the simple rules, then you can go and make it as complicated as you want. But what you'll find is that when you overcomplicate it and you dial it back and you make it simple again, you will make more money. It is not always possible to achieve the perfect trade setup, so you have to decide if bending the rules is within your risk tolerance. Now, cash is a position too, guys. You don't need to be fully invested. Now, there's a little side tip on that. Don't have all of your money in the market. keep some money on the sidelines as well. Every day there's new opportunities coming about, so you don't have to put everything in the market. Margin. This is really important to pay attention to with this. When you write a naked put, you earn the credit for selling the premium. Remember? We're the insurance company. We're selling somebody the insurance that is buying the put just in case their stock goes down. So they pay us the premium. That money comes into our account. However, the broker is going to set aside some money to cover part of the risk. This is known as margin. When you place a trade, you will see the amount of margin required. Margin is fluid, meaning that it changes dynamically as the stock prices goes up and it goes down. So the closer you get to being in the money, the margin increases. And conversely, the further the stock goes out of the money, the more the margin decreases. So it's all about risk, guys. The premium is all about risk. The insurance premium is all about risk. The margin is all about risk. The greater the risk, the more margin the broker is going to charge you. Now, opening and closing naked put trades. To open a trade, we sell to open. To close a trade, we buy to close. Now, writing puts is not that scary. So let's take a look. Let's have a look at how do we write a put. Okay, we're looking at a chart here on BA, which is Boeing, trending sideways, which is really nice, on a bit of an uptrend here as well. So I'm looking at this for a naked put. So if we have a look over here at Boeing, we've got our implied volatility of 38.6. That's not too bad. I like it being up around the 50s or more, but 38, that's okay. These are trades that I'm already in now, so we can see these lines have already been marked on here because of trades that I'm already in. So on a naked put, we want to sell a put at a price we don't think the stock's going to go down to. So we can see here at the 120 and the 115 where it's been having problems getting down below here. Okay, so that's a beautiful support level for us there. So let's have a look at that. We go over here to trade. I'm looking at the July 17. Today is the 2nd of June, so that meets our requirement of 30 to 60 days. So if we looked at the 115s, so we click on that to sell. If we look down the bottom here, we'll see 224. So that's $224 per contract. And our buying power effect that we're going to have here is $1,283. That's what the broker's going to take out of our account to set aside for our partial risk on that trade. Remember, our margin is going to be fluid, so that's going to go up and down as Boeing goes up and down in price. We look at our delta of 10.25, that's great. That's lower than 20, so it ticks all the boxes for us there. And our 224 is certainly more than 75 cents, so that's great as well. So to execute this trade, we simply click on Review and Send. Now let's have a look at our return on that. So our ROI, 224 divided by 1283. Okay, that's going to give us a 17% return. Now, as soon as I place my orders, well, as soon as I'm filled, I always place an order to get out of that trade at 50% of my maximum profit. So that's going to give me a bit over an 8% return if I get out at 50%. Well, 8% for a week to 2 weeks, that's not too bad at all. Now, what if we, instead of writing the 115s, we wrote the 120s? Okay, so why would we do that? Let's go back here, the 120, yep. Okay, we're still okay with that. So we go here. So now it's bought on a higher risk because it's 120 instead of 115. So that's going to give us a greater return, 295. And our buying power is 1212. And our delta is still below 20. So we're okay with all of that. So let's have a look at that as a rate of return, 295. divided by 1212. So now we're looking at a 24% return. So you can see our return has increased from 17% up to 24% because our risk is greater. We don't want Boeing to go below $120. While before, we didn't want it going below $115. So we take on more risk, we bring in more premium. So that shows you how quick and simple it is to place a naked put trade. Okay, that was a pretty good example, wasn't it? Pretty simple? Excellent. Okay, some other things we need to consider here, guys. Early assignment. Buying options versus selling options. So let's have a look at the puts here. The bottom right. Have a look down here. When we are selling puts, you have the obligation to buy a security, in this case a stock, at a specified price. So you have the obligation to buy it. You have to. If you assigned it, you have to buy it. Now, early assignment simply means that the put buyer can put the stock to you at any time. This generally does not happen prior to expiration, as there is still time value left in the option. But it can happen. Logic says somebody will not put the stock to you before expiration because if there's still time value in there, they're throwing that time value away. So if the stock is put to you early assignment, I guess that's a bit of a bonus, isn't it? Right? So if it does, and you do not have enough money in your account to cover the purchase of the stock, your broker will give you the choice of adding more funds to your account, or they may even close out some of your positions if you don't add funds to your account, or if you don't close some positions to have enough in your account to cover that. Now, there's really nothing to stress out about. If it's put to you, you simply sell the stock. And if you still like the trade, if there's still some good value in that trade, enter it again. Treat it as a bonus because somebody put the stock to you and there was still time value left in that option. Now, some important exit guidelines. We covered the entry guidelines before. Now let's look at the exit guidelines. When your entry order is filled, immediately place an order to close your trade at 50% of the maximum profit. Got that? 50% of the maximum profit. So whenever we enter a trade, we know what our maximum profit's going to be. So what we need to do is we need to have the mindset of, okay, if I can get 50% of that profit, I'm happy with that. So let's place an order immediately and get the trade to be taken out the moment we hit that maximum of that 50% profit. For example, if you sold a put for $1 of premium, place an order to buy it back for 50 cents. Buy to close. And in one of the advanced trading videos, I teach you exactly how to do that. Always exit your trade prior to expiration to eliminate any danger of it expiring in the money. Because if your trade does expire in the money, you will be assigned the stock. Now, guys, we don't want the stock in our account. We don't want to have to buy the stock. What do we want? We just want the premium. Give us the money. Let us insure it. Let us insure that other person's stock. Keep the money. Keep the premium. So get out of your trade before expiration. Now, what about protecting our position? Can we protect it? Can we protect our naked put? Naked put simply means writing a put without protection. So you can protect your naked put position by buying a put further out of the money to protect the downside risk of writing naked puts. This is what is known as a put vertical spread or a bull put spread. Now, vertical spreads are a fantastic strategy as they are both the maximum profit and the maximum risk defined. I always suggest that new options traders cut their teeth on vertical spreads. In one of the future videos, you are going to learn about how to do vertical spreads. And if we're doing a vertical put spread, we do a bull put spread. See, with your naked put, the risk of that is pretty big because that stock could go down to zero. And the more the stock goes down, the greater the risk, the more money that you would be losing on that trade. Well, if we turn that naked put into a bull put spread, you are maximizing your risk. You are defining your maximum risk. Never let a naked put expire in the money. When would you let a naked put expire in the money? Never. Never, ever, ever let a naked put expire in the money. Why? Because you will have the stock assigned to you and you'll have to go and buy the stock. So remember, one option contract controls 100 shares of stock. So for every contract that you have, and if that expires in the money, you will have to buy 100 shares of that stock. So if that stock's worth $100 and you have to buy 100 of them, but if you've got 10 contracts, that's 1,000 of them. Do you get what I'm saying here, guys? I'm going to say it one more time. Never let a naked put expire in the money. When a put option expires in the money, shouldn't even have to tell you this because it's not going to happen to you because you are going to follow the rules. You are going to get out of that trade so it doesn't expire in the money. But this is what happens, guys. A put option is considered in the money if the strike price is higher than the current stock price. The seller of a put option that expires in the money is required to buy 100 shares of the stock per contract at the option's strike price. For example, if the stock is trading at $100 at expiration and you had previously sold a $110 put, you are obligated to buy the stock from the seller at 110. Therefore, you would have 100 shares of stock in your account that are worth only $100 each, but you just paid 110 for them. If you sold them immediately, you would lose $10 per share or $1,000 per contract. And guys, we don't like losing money. We want to make money. Margin calls. What is a margin call? As mentioned earlier, margin is fluid, meaning that it changes dynamically as the stock prices go up and down. So the closer you get to being in the money, the margin increases. And conversely, the further the stock goes out of the money, the more the margin decreases. So, never use up all of your funds in your trading account, or you will receive what is known as a margin call. So if you don't have enough money in your account, the broker's going to be saying, show me the money, give me some more money, feed the beast. If you receive a margin call, your broker will demand that you add extra funds to your account, or they'll demand that you close some of your open trades to cover the costs. If you do not comply, generally within 48 hours, your broker has the rights to close any of your open trades to cover that margin call, to cover those costs. If this happens too many times, your broker could close your account and ask you to take your business elsewhere. So let's think about it. The broker is providing you the opportunity here. So you know the rules. You know that if you get a margin call, you have to add more money into your account or close some open trades. So if you're going to be a pain in the butt and not follow the rules, and you're not going to comply with them, and that broker has to go and sell some of the positions that you have open and have to do all this extra work, why would they want you as a client? Okay, just do the right thing. Now, you're not going to get this margin call if you follow the rules. Shouldn't say that, because you could get a margin call if there's a massive move in something that we haven't been able to predict. So again, this is why I always say, don't use up all of the funds in your account, because your margin is fluid. And then if you follow my rules and learn vertical spreads and cut your teeth on vertical spreads and perfect them first, then you could be looking at being naked in the market. So be responsible, guys. Never use all of your money in your account. Trading is a business. This is your business. If you had a shop, you're not going to use up all the money in your cash register. You're not going to use up all of your money in your bank account. If you do that and you've got bills coming in and you don't have the money to pay for it, you're going to be in trouble. The same deal with your trading. Your trading is a business. Be a professional trader and treat it as a business. The education process. Repetition. We must watch or listen to material 5 to 7 times before we fully comprehend it. Go over it again and again. I've covered a lot in this tonight. I've covered a lot of new material here, guys, that may be over your head. It may not be, but if it is over your head, so what? Just go back and watch it again. Watch it a couple of times, and then you'll get that aha moment, the moment the penny drops. Aha, I've got it now. Paper trade. Paper trade at least 10 profitable trades in a row before using real money when we learn new strategies. Practice makes perfect. Heard that before? Well, that's wrong. Perfect practice makes perfect. That's the 3 P's of trading. See, practice does not make perfect if you are practicing wrong. So we have to perfect our practice and make it perfect. Think big. As long as you have to think anyway, how about we think ginormous? Now, if you haven't joined my online trading room yet, it could really be your key to freedom. It can take you from working 60 to 80 hours a week to only 30 minutes a day. And no, you don't have to be like that picture on the left-hand side. You don't have to have 3 monitors there staring at them, analysing everything. That's my job. Yes, I have 3 monitors. That helps me to be able to find great trades for all the people that are in my online trading room. Because what I do in my online trading room is that you're virtually leaning over my shoulder, watching me place live trades. You could be like that family there on the right, having a great life, sitting on the beach, spending 30 minutes a day adjusting your trades. I have an offer for you now with my online trading room, where you'll get access to my advanced training videos and my trade alerts. $14 for 14 days in my trading room. Let me be your mentor. For today only, $14 for 14 days. You have no long-term commitments. That's purely a trial. You can cancel at any time, and I'll give you unlimited personal support. You'll get access to our exclusive Telegram group, so you can write to me directly and personally. And at the end of that 14 days, if you don't think you've received $14 of value, just send me a personal message and I'll refund your $14 and we'll part as friends. But $14 is a very small price to pay to get access to all of my advanced training and to also to be able to join in on our exclusive Telegram group. So hit the subscribe button below and I'll see you in the members area.